Question 13 is asking us to calculate the capital gains tax which would arise on the disposal of a property, assuming a tax rate of 20%. So in order to work out the tax charge, we first of all need to work out the gain, which will require us to go and take the proceeds figure of 500,000 less the original cost of 110,000, and then go and think about any enhancement expenditure. In this case, we've got two potential enhancement costs. First of all, 40,000 being spent to repair the roof, which normally as a repair would not be deductible. But in this case, it was necessary for us to spend that money to bring the property into occupation. So yes, that would be included as part of an enhancement cost. The cost of the extension is definitely an improvement, definitely an enhancement. So yep, in calculating our gain, we'll deduct both the 40 and the 75,000. However, that isn't quite the end of it, because the other thing we need to think about is indexation allowances using these indexation factors that we've been given here. So in this case, back in 2005 when the property was originally bought, we spent 110,000 on it, plus the 40,000 repairing the roof, giving us total expenditure of 150,000. And it's this figure that we'd claim the indexation on at this rate given to us of 30%. In 2007, this is when the extension is built, so we incur costs of 75,000, and on this figure we'll use the second indexation factor given of 20%. So that in calculating our gain, we end up with indexation allowances of 45,000 from 2005 and 15,000 from 2007. When we work all of this through, what this should leave us with is a gain of $215,000. Based on that gain, the tax charge would arise at a rate of 20%. And so in this case, the final tax charge that they were wanting us to calculate would be $43,000.